A mortgage lender collapses, and suddenly, over $1.3 billion is missing. Major banks exposed, regulators stepping in. So how did this happen? Almost overnight. The company at the center of this story is Market Financial Solutions, a UK-based lender specializing in short-term property loans. These loans are crucial for investors looking to move swiftly in real estate deals. They act as a financial bridge between transactions. According to industry reports, this type of lending is vital in keeping property markets fluid. It allows transactions to proceed without the delays of traditional financing. However, like many complex financial systems, it relies heavily on a delicate balance of trust, liquidity, and transparent reporting. Market Financial Solutions flourished during a period of strong demand for flexible lending. Low interest rates and an active property market landscape created lucrative opportunities. The firm capitalized on these conditions, expanding its operations and forging relationships with major financial institutions. Funding was sourced from various channels, including large banks and investment groups. They were eager to invest in the thriving real estate sector. As the business grew, so did its influence within the lending ecosystem. On the surface, everything appeared to be functioning seamlessly. Yet, beneath this veneer of success, subtle cracks began to form. According to financial reporting and court-related disclosures, early signs of trouble emerged. Questions arose around the structuring and security of certain loans. Was there a possible mismanagement of assets? Speculation mounted over the practice of double pledging, where assets are used multiple times as collateral. This tactic can create an illusion of solvency but hides significant risk. Concurrently, financial pressures mounted as market conditions tightened. This placed the firm under increased scrutiny. As these concerns came to light, the situation escalated rapidly. Outlets like Reuters and Bloomberg reported a swift reassessment of exposure by lenders and investors. Confidence in Market Financial Solutions waned, and access to funding became increasingly precarious. Within a short span, the company entered administration in early 2026. Reports revealed a staggering shortfall of approximately $1.3 billion. This triggered a swift response from regulators, including the UK's Financial Conduct Authority. They launched comprehensive investigations to uncover the root of the financial discrepancies. Amidst the ongoing investigations, the full scope of the situation is still being pieced together through official processes. According to public reports, administrators are meticulously working to assess the company's assets and liabilities. Creditors are evaluating potential recoveries. The regulators continue their thorough review, leaving no stone unturned. Although no final conclusions have been publicly confirmed, the financial impact of this collapse is already evident. This sends ripples through the lending industry. The case of Market Financial Solutions serves as a stark reminder of the vulnerabilities that can exist within financial systems. The reliance on transparency, structure, and trust becomes paramount when any of these elements are called into question. The effects can spread swiftly, influencing lending conditions, investment decisions, and overall market confidence. These factors affect everyone, even those not directly involved in the financial sector. As we delve deeper into this unraveling story, we begin to understand the complexities and risks associated with rapid growth within financial systems. These risks, often concealed beneath layers of financial maneuvering, can become perilously apparent when scrutinized. The narrative of Market Financial Solutions is far from over. This leaves us to ponder the broader implications and potential warning signs for the industry as a whole. In the intricate web of modern financial systems, this collapse prompts us to question whether it was an isolated incident or indicative of deeper systemic risks. The unfolding investigation will likely reveal more about the internal dynamics that led to such a dramatic downfall. What remains clear is the need for vigilance and the importance of maintaining a robust framework of checks and balances in financial operations. As we pause at this juncture of the narrative, the journey into understanding how a seemingly stable entity like Market Financial Solutions could face such a dramatic collapse continues. With the financial world closely watching, the next phases of investigation and resolution hold crucial insights for the future of lending practices and financial regulation. As the investigation into Market Financial Solutions deepened, a complex web of transactions and financial maneuvers began to unravel. At the heart of the issue were concerns about the integrity of the company's balance sheet. Investigators discovered that the firm's financial statements were not merely a reflection of poor management, but suggested deliberate misrepresentation. This revelation raised questions about the accountability of top executives and their involvement in potentially fraudulent activities. Key figures within the company, including the CEO, financial officers, and board members, were brought under intense scrutiny. According to insider sources, internal communications indicated that some executives may have been aware of the precarious nature of the company's financial practices. Whistleblower testimonies began to emerge, shedding light on a culture that prioritized aggressive growth over sustainable financial practices. These testimonies were pivotal in piecing together the sequence of decisions that led to the eventual collapse. Among the many issues highlighted was the company's reliance on creative accounting techniques to inflate assets and understate liabilities. Investigators found instances of loans being rolled over without adequate collateral, effectively masking the company's true financial health. These practices were facilitated by a network of intermediaries and brokers who played a crucial role in securing new funding streams, often without due diligence. Reports indicated that some of these brokers operated independently, motivated by high commissions rather than the company's long-term viability. The impact of the collapse extended far beyond Market Financial Solutions. Major banks that had invested in or partnered with the firm faced significant financial exposure. Institutions such as Lloyds Banking Group and Barclays found themselves reassessing their own risk management frameworks. This, in turn, prompted a broader industry-wide reflection on lending standards and the robustness of financial oversight mechanisms. As the probe continued, attention turned toward the regulatory environment that allowed such practices to flourish. The Financial Conduct Authority faced criticism for its perceived lack of vigilance. Analysts argued that despite existing regulations, there was a failure to detect early warning signs and enforce compliance. This criticism fueled debates about the need for more stringent and proactive regulatory measures to prevent similar occurrences in the future. Public reaction was swift and vocal. Investors, many of whom were small-scale property investors relying on bridging loans for their projects, expressed outrage and concern over the security of their investments. The loss of trust in the financial system was palpable, with many questioning the efficacy of regulatory bodies and the transparency of financial institutions. This sentiment echoed through the financial markets, affecting share prices and investor confidence across the board. The media coverage of the collapse was relentless, with headlines highlighting the scale of the financial shortfall and the potential for widespread economic repercussions. As more details emerged, public interest in the case grew, drawing comparisons to past financial scandals that had rocked the banking sector. The narrative of Market Financial Solutions was now intertwined with broader discussions on corporate governance, accountability, and ethical business practices. Meanwhile, within the corridors of power, policymakers were prompted to act. Proposals for legislative reforms aimed at tightening financial regulations gained momentum. These measures focused on enhancing transparency, improving accountability for senior executives, and strengthening whistleblower protections. The collapse of Market Financial Solutions became a catalyst for change, compelling lawmakers to reconsider the frameworks governing financial operations. Despite these developments, the task of untangling the financial mess left by the company remained formidable. Administrators worked tirelessly to identify and recover assets, a process complicated by the intricate layering of financial transactions and the involvement of multiple parties. The challenge lay not only in recovering funds, but also in restoring confidence in a sector that had been severely shaken. As the story of Market Financial Solutions continued to unfold, it served as a sobering reminder of the fragility of financial systems. The case underscored the importance of vigilance, transparency, and accountability in maintaining the integrity of financial markets. With each new revelation, the narrative grew more intricate, highlighting the interconnectedness of global financial systems and the far-reaching consequences of their failures. The ongoing investigation and its outcomes were closely watched by stakeholders worldwide, from investors and regulators to financial institutions and policymakers. The lessons gleaned from this collapse would undoubtedly shape the future of financial regulation and lending practices, offering insights into the prevention of similar crises. Yet, as the inquiry delved deeper, the full extent of the implications remained to be seen, leaving many questions unanswered and the story far from over. As the investigation reached its final phases, new revelations emerged about the role of external auditors. It was discovered that several audit reports had been signed off, despite glaring inconsistencies in financial records. This raised questions about the potential complicity or negligence of the auditing firms involved. Consequently, the UK's accounting watchdog, the Financial Reporting Council, launched a separate inquiry into these auditing practices, examining whether standards were compromised or overlooked. Meanwhile, international repercussions began to surface. The collapse of Market Financial Solutions sent ripples across the global financial landscape, influencing investor behavior in markets far beyond the UK. International banks, with exposure to UK property loans, revisited their risk assessment models, leading to tighter lending criteria and a more cautious approach in cross-border transactions. This shift in behavior underscored the interconnected nature of modern financial systems, where the downfall of a single lender could impact global financial stability. Amid these developments, affected property investors and smaller financial entities pursued legal action, seeking compensation for their losses. Class action lawsuits were filed, emphasizing the need for accountability and restitution. These legal proceedings highlighted the broader social impact of financial collapses, affecting individuals and communities who relied on bridging loans for economic opportunities. In the halls of government, discussions about financial reform continued, with bipartisan support for measures aimed at preventing future crises. New policies emphasizing transparency, accountability, and ethical practices in the financial sector were drafted, promising a more secure financial future. The story of Market Financial Solutions, now a landmark case in financial history, serves as a poignant reminder of the fragility and complexity of global economic systems. The echoes of its collapse will resonate for years,